Assalamu alaikum friends, welcome to lecture 16 of AFM, last lecture under reconstruction and reorganization. So in the previous lecture, lecture 15, we did financial reconstruction where we talked about how you can change the debt to equity or equity to debt or equity of one form to another equity or debt of one form to another debt in order to improve the performance of the company. And also we show the impact on your earnings per share and on your statement of financial position by using a tabular method that you have to do in an exam. Now in this we are going to talk about business reorganization. This is a little different from financial reconstruction because here we are not talking about debt and equity. Okay, here we are going to focus on demerger. As I told that this is the opposite of merger, where one company becomes two separate companies, or you can say it spin off. What are the advantages, disadvantages? You have to know. Okay, these are the ways of restructuring. Then sell off. Sell off is different from spin off. Okay, we'll see. Then we have management buyout. Remember these terms, these things you have to know because you have to write on this. Okay, as well as calculation. Management buyout versus management buy in. So first, unbundling companies. Do you know the meaning of bundling? Bundling means you bring one or two things together and it's in a bundle. Now you are separating each one from the other. If it's in a part of a group, okay, if two three companies are part of one group, now you're separating them from that group. That is known as unbundling. How do you unbundle companies? There are various ways of doing this. Okay, and why would you do that? Same way, same objective. We acquire a company because we feel that it will give us a benefit. It can increase our shareholders' wealth. Same way, if we feel that by selling off a company, we can improve the wealth, maximization of the shareholders' wealth, we can improve our current performance, we can concentrate on our core activities, right? We go for reconstruction or reorganization. You understanding? The same way. That's why we sell off. So there are various ways of unbundling this, not just one way. Okay, unbundling means you're selling off those activities which are not very important for your business. They are non-core business. Okay, you might do it in order to release funds. For example, if you want fund, okay, currently you are facing shortage of cash, you want fund, so you sell off those businesses which are not doing so good, or you might sell off to reduce your gearing so that you can pay the bank, you can pay the interest, or the third reason could be so that you can concentrate on your core business. But whatever the aim is, whether to release fund, whether to concentrate on core business, whether to reduce gearing, main aim is to improve the shareholder wealth. Remember, in AFM, we'll start from the beginning. We started with investment appraisal, right? Having positive net present value. Then we did various methods, payback period, IRR, MIRR. The reason we did all this was one, to maximize shareholders wealth. Then we moved to risk management. We hedged our currency risk using various derivatives. We hedged our interest rate risk using various derivatives like swaps, option, forward, future. Why? To improve shareholders' wealth. Then we went to acquisition and merger. We acquired only if it improved shareholders' wealth, right? Otherwise, no. Now coming to the fourth topic, that is reconstruction and reorganization. The same thing. We restructure or we reorganize if it improves our shareholders' wealth. So everything in AFM you can sum up to one thing. It has to improve your shareholders' wealth. If it is, that's the right decision. If it's not, you should not do it. Simple. Simple. So unbundling can come in various forms. Number one, demerger. Remember, demerger means your ownership is not changed. Okay? It's only that now you're forming a new company. Okay? Earlier it was one company. Now that one company is becoming two or more companies, but still the same shareholders. You understanding? That is the meaning of demerger. How we merged two company becoming one, demerge is the opposite. One company becoming two or more than two. Sell off. Sell off means when you're selling a part of a business to a third party and for which you are going to get cash. Okay, it is part of the original business that you're selling off. Remember, sell off means you are not the shareholder in that business, but demerger, you are still the shareholder of that new company. That is the difference between sell off and spin off. Or if you are getting so confused between spin off and sell off, then just don't write spin off, just refer to demerger and sell off. Okay, or another way to remember this is concentrate on sell off. Sell off means you're selling to an outside party. So spin off means it's a demerger. Okay, you're just spinning it. You are still the same shareholder. Okay, just remember one thing very well: sell off, selling to third party. Spin off, automatically you will remember. Okay, coming to the third way of unbundling is management buyout. This is very common in your AFM exam. Most of the time examiner asked this. You will see in your past papers also. This has been asked many times. So you can be sure that you are going to get this. Most frequently, very high chance of this coming in your exam is management buyout. You have to know the advantages, you have to know the disadvantages, you have to compare this with management buy-in. What are the various forms of financing this? All the aspect of management buyout we are going to cover in this lecture because everything has been asked in the exam. Not in one paper, but in different papers, many aspect of this has been asked. So, but in your exam, any form of unbundling could come. It could be a demerger, it could be a sell-off, it could be a management buyout. You have to be prepared. You have to see which one it is. Accordingly, you have to answer. Okay. So, management buyout means, remember, again, I'm repeating, management buyout means your existing management are buying the business from you, or in other words, you are selling your business to the existing management of the company. You're selling your business, the shareholders are selling to the manager of the company. Which manager? The internal manager, the manager who is still there in the business as an employee. They are now taking a stake in that company. Now they are the one who is going to have the control of that business. That is the meaning of management buyout. Management is buying it from you. Management buy-in. It looks like that management buy-in is internal and management buyout is external manager. No, it's the other way around. Management buy-in means external manager which are not in your company are buying the company from you. This is the difference. Later we'll compare the two, don't worry. We have a table to compare. Then unbundling, another way, which is the last, is liquidation, which is not usually liked so much. Okay, we tend to avoid it, is liquidation. Just sell the entire business and close it down. Sell the assets, whatever the process you get distributed among the shareholders. Okay, that's the last stage, unbundle. But remember, this last stage is usually the last resort. When you come to this stage, when you can see that your business is no longer going to run, you don't see it any longer viable, you do not see any future for the business, then you go for the liquidation. Okay, unbundling is all the ways through which you can sell off or reduce the operation of the business. That is the meaning of unbundling. Okay, it is no longer there. It's like what do I say, dispose. In acquisition merger, what do? You acquire, you purchase. Here you sell. Okay, that's why I told you, if you're very good in acquisition merger, you'll be very good in this also. Now we are moving on to demerger in detail. Okay, the aim is just to create a separate business. Why do you have a separate business? Why do you think? What is the advantages? Because sometimes having two separate businesses gives a higher value than having that one original company. Okay, these are the characteristics you will find in a demerger. So in your exam, see if the examiner does not write it's a demerger or not. You have to see whether these things are there or not. Number one, does the shareholder have the same proportion of shares in the new business as well they did in the previous one? If yes, it's a demerger. Second, each company owns a share of the assets of the original company. There could be 4 companies, 5 companies, but all those 5 companies have shares in that original company. Third, new company, okay, they have new management there. Okay. So every company, let's say three companies are being created out of that one company. All three companies will have separate management. Now it is up to the management in which direction they want to take. Okay. They can individually they will run it and they can even sell it off also separately. And the fourth characteristics is original company may no longer exist because you have demerged, no? All the assets that is there in that original company, the main company, it is now distributed to the new business. Distributed among the two business or three business, or the examiner will tell you how many businesses it has been demerged into. Now we are moving into sell off. Why do you want to sell off? These are the reasons: to raise cash, to prevent a loss making. Okay, you can see that a part of a division of a business is in loss making, and you can see that if you keep it, if you retain it, it will going to affect the performance of the other divisions also, profit making division. So you want to prevent that from happening, you sell off. Third, so that now you have more time to concentrate on the core areas of the business. Or the fourth reason, remember this is from the point of accusation, you want to dispose a desirable part of the business. Please understand, you want to dispose a desirable part of the business to protect the rest from the threat of a takeover. Think from the acquisition point of view. Why a company wants to take you over? Because you have some desirable assets in your company. Or they can see that there is one division which is very desirable, okay, which is a profit making division. So if you have it, you are a target for a takeover. But you do not want your business to be taken over. You understanding? In order to protect yourself, you sell off that desirable part so that you no longer are an attractive company to be taken over. You understanding? So you dispose. That could be a reason. Now we are moving on to the management buyout. The short form is MBO. Okay. See, there are several variants of this. Okay. I have explained it below. It is not a must that you are going to get in the exam. You might not get any of it. But knowing the definition will help you. Number one, management buyout. As I told you, current managers, now they run the business, right? Second, leveraged buyout. What is leveraged buyout? Leveraged buyout means, okay, see, in the management buyout, it is the manager's responsibility. They put up the bulk of the finance that they require for this purchase, right? They get the resources. But in leveraged buyout, let's say the purchase price is beyond the financial resources of the managers. What do? They go for a loan. So partially it is the managers who are financing it, but the other half, or not to be precise, not even half, but the other part of it is financed by the loan, by taking a loan. Understanding? From other investors. Leverage buyout. Third, employee buyout. Employee buyout is very similar to the above categories, but here the employees are going to have a stake in the business, right? Management buy-in. New managers come and take over. And spin out. Spin out means this is very similar to a buyout, but parent company maintains a stake in the business. Remember, if it's a spin out, parent company still will have a stake in that new business. But if it's a management buyout, only managers will run. The parent company will not have any stake in that business once they sell it to the manager. That's the difference. Now, this is very important from your point of AFM exam. Okay, if you are asked to compare, you can use this between MBO and MBI. MBO is existing managers purchase it and run the business. MBI is outside managers buy it and run the business. Second difference is see, since you are an existing manager of that company, it's beneficial for you because you have detailed knowledge of that business. Whereas MBI, they are external managers, they will not have detailed knowledge. Another thing is, because they are existing manager, they will cause less disruption also. And even employees also will not resist so much because they know the manager. But for external manager, more disruption and employees might resist. Here, For MBO, former parent company might find it easier to work with existing managers, isn't it? Because they know they have been their employees. There's a familiarity. They're familiar with each other. But for external, it's not the same thing. It's difficult. Then we have some more existing management. These are the disadvantages of MBO now. Earlier we went through advantages. Disadvantages is existing managers might lack all the new ideas that is required to rejuvenate the business. Whereas MBI, since they have acquired the skills from elsewhere. They have experience from elsewhere also. They can bring fresh idea into the business and run the business even better. Understanding? Existing management, they might not have all the financial arrangements that they need. Whereas MBI, okay, they might have the requisite level of finance in place already. Now, reasons for a management buyout. Why do you want to buy out? Why do shareholders simply want to sell to their manager? These are the reasons. These are the reasons. Maybe the parent company is facing some financial difficulties and they require cash. Or they feel that subsidiary of that parent is not fit with the parent's overall strategy, so they want to sell the subsidiary to the manager. Third, if it's a loss-making part of a business, okay, they feel that it's better to sell to the manager rather than liquidating it. Why? Because there are so many costs. Liquidation is not easy. You have to wind up redundancy, you have to make your employees redundant, pay them compensation fees. Those are very huge. Rather sell it to the managers. Fourth reason, victim company could be an independent firm, okay, whose private shareholders wish to sell out. So this could be due to liquidity and tax factors or the lack of family success to fill the owner manager role. Let's say in your business you do not have someone to take over after you, okay, so it's better you sell out that, okay, it could be for any reason. Now, what are the advantages? See, there are, whenever advantages are asked of buyout, remember it goes to two separate people. One is the manager, one is the parent company who's selling it. So advantages to the parent company is, number one, if the subsidiary is loss making, remember selling it is better financially than liquidation. Second, the buyer is known, so the risk is reduced. You don't have to do a due diligence on the buyer, right? Third, this also earns a better publicity also. Why? Because employees' jobs are not cut, right? Employees are not going to lose their jobs. Rather, now they can run that business as an owner. But if you close that business down, employees are going to lose jobs. Fourth is, okay, it's better to sell to your existing manager rather than selling it to the competitor. Correct, no? Now, advantages to the management, the one who have acquired it from you. Their jobs are preserved, okay? It offers them a prospect of significant equity participation in their company. Third, rather than starting your own business from scratch, isn't it better that you already take a business and convert it into success from your shareholder? Then, now they can carry out their own strategies. The manager, they do not have to seek approval from head office anymore. Remember, there are some issues that needs to be addressed when you are preparing a buyout proposal. What are those issues? Number one issue is, do the current owners wish to sell? See, if the answer is yes, it's very easy. The process is very easy. Okay. Second, will the new business be profitable? Because even if the managers take it over, manager were running the business as a manager. They were managing the thing, but running a company as an owner is a different thing. Do they have the expertise? Do they have the resource to do it? Can they convert a loss-making business into a profitable? That's a question that needs to be asked. And you don't even know whether the new business will be profitable as the old one or not. Third, if loss-making, can the new manager return it into profitability? I already answered that. Fourth, what will be the impact of loss of head office support? See, now you're losing a head office support. Earlier you had that when you were a manager. So what would be the impact of that? What is the quality of the management team? Are they high quality people in the team? What is the price? Are you paying too high a price? Or are you receiving too low a price? Is it a deal in the best interest of shareholder? What is the purpose of this buyout? To maximize shareholders' wealth. If that is not maximized, then what's the use? Okay. Now, what are the sources of finance for buyouts? Remember all these things, advantages, disadvantages, comparison, issues. Now the sources of finance are regarding buyout only. So buyout itself is a big topic. Anything on that area can come. Be prepared for it from all the areas. Sources. How do you finance the buyout? Number one, clearing banks. Banks might give you loan, or you might take pension fund or insurance company, or merchant banks, or specialist institutions like 3E Group. Government agencies can help. Assess the viability. How do you make sure that buyout is viable or not? Number one, see, both the management team and the one who is giving you the finance, it could be bank or pension or anyone, both of their objective is they want the MBA to be success. That's why they will ask you these following questions and you need to answer them. Number one question, why do current owners wish to sell? Is it because they want to get rid of a loss-making subsidiary? Are the new managers overconfident that they can turn it into profitability? Second, does the management team cover all the key functions? That means, do they have the human resource? Do they have the marketing? Do they have the sales? Do they have the finance department? Or they should appoint. Third, business plan needs to be drawn up. Is it there? Is cash flow projection ready? Have accountant check those figures. Is the purchase price too high? All these questions will be asked by the people who is going to finance this, remember. Okay. Is the financing method viable? The trend is now away from highly geared buyouts. That means rather than relying too much on loan, you need other sources of finance because your gearing will go up in that way and it becomes very risky, right? Now, we have moved on to the last aspect of this lecture. That is evaluating the benefits of reorganization. There are three important benefits of reorganization. Okay. Number one is because it helps you to concentrate and maximize your shareholders' wealth. Okay, these are the things. Okay, how you can get those values. Okay, number one, how you can concentrate growth and maximize shareholders' wealth. Number one is because now you're splitting off the non-core activity from the rest of the business. You understanding? So because of this, okay, because of this, it will increase the visibility of an undervalued asset, which is then valued more highly by the market after you split off the non-core activity. Second, businesses may be valued more highly in the hands of the new manager than under the previous. See, evaluating the benefits of reorganization means we are talking about all sell-off, spin-off, demerger, MBO, everything together. This is like a summary, you can say. Okay. So in the hand of the new manager, business may be valued more highly. Second, selling of a less profitable part of the business is viewed more positively by the market. because it can even increase your valuation of the business for the rest of the business, remainder of that business. Understanding valuation, we studied valuation, right, in mergers and acquisition. So that's the thing. And because of this unbundling, what happens? Performance of your individual business will improve, means higher valuation. Second benefit is it reduces complexity and improve managerial efficiency. How? Number one, see, if you're having a diversified business everywhere you are having, it's very complex to manage, isn't it? And during the pace of change, when things go wrong, it's very difficult to change a huge, I mean, it's very difficult to manage a huge business. But short business, small businesses, it's easier. They are quicker to adapt to the changes. Second, smaller companies, they are more flexible. They can respond to change very easily. And the third, following a demerger, now the new companies, they have more clear, more focused management structure. That means managers become more efficient now. Third benefit is, sorry, we have more in the second one. It also improves managerial effectiveness, okay, because they have now more free time to concentrate on the core activity. Also, changes in the market might mean that benefits of synergy might no longer exist. That means you do not have any reason to retain that business. Sell it off. Third benefit is it will help you to release the financial resources for new investment. When you sell off a part of a business, you will have some financial resource, right? You are going to get cash, use it for the new investment. Because if it's a loss-making part of the business, maybe so much of your funds are absorbed in that. Release the cash and invest in co-business of new activities. Either in your core business, you can invest using that cash, or some new activity which can generate a higher return. Second, a reduction in the size, okay, can also reduce your central management cost and it can free up resources. Unbundling, remember, unbundling generates a lump sum in proceed. Once you unbundle, whether it's demerger, whether it is management buyout, whatever it is, you are going to get a lump sum for it. And this lump sum can be invested in specific projects. So that's it for this lecture. Before we summarize, we are going to do one whole question on this. So let's do that. So in this question, I have included the solution for you, okay, so that you can see how an answer like this looks like. Basically, it's in a form of a report. I wanted to show you the format of a report because you are going to get a professional marks for it in your AFM exam, the 4 professional marks, and also the way it is presented. So the question is, the following information relates to the proposed financing scheme for a management buyout of a manufacturing company. 40% is for the management, 60% is for the institution. Okay, you have redeemable shares, you have loan, overdraft, and some information. Let's read. Loans are repayable over the next 5 years in equal installments. They're secured on various specific assets, including properties. Interest is 12% per year. The manufacturing company to be acquired is at present part of a much larger organization which considers this segment to be no longer compatible with its main line of business. This is despite the fact that company in question has been experiencing revenue growth in excess of 10% per year. Assets to be acquired have a book value of this, and agreed price was this. Agreed price is more than the book value. You are required to write a report to the buyout team appraising the financing scheme. Part B. What problems are likely to be encountered in assembling a financing package in a management buyer of a service company as opposed to a manufacturing company? This is a new question. This was not there in your lecture, right? You will face some question outside what you have studied. Don't worry. Every year you will see one question that is very different. The best strategy to handle this type of question is don't leave it unattempted. You have to attempt it. Whatever you can think of, whatever you can see, at least you know there are some differences between manufacturing and service, right? Talk about that. If you have to talk about financial package, it is more difficult in service than manufacturing. Because in manufacturing, we know the cost of assets, we can see assets are tangible, but in service company, we don't have so much of tangible assets, so it's difficult to put a value on that. Understanding one difference is that. So like that. Now let us go to the solution. First, let's do part A. This is what I wanted to show you. They asked for part A report. This needs to be there. This is the format of a report. To, from, date, subject. Always start to whom you are writing this report. They already told you. Write a report for management buyout team. So to buyout team. From whom? They will tell you who you are. If nothing has been mentioned, just say you are a consulting accountant or a consulting financing manager or anything like that. Here you are a consulting accountant. Okay. Date. Write the date on your exam paper, whatever the date is. Subject. Keep it very brief. 3 to 4 words or at least 5 words is the best. Do not exceed that. Okay. It depends on the case that is given. This is regarding management buyout financing scheme overview. Okay. That is up to you, whatever subject you want to get. But make sure that by reading the subject, someone will be able to tell what is there. So this is regarding management buyout finance scheme. Okay. Now, start with the introduction. So this financing scheme involves what? Purchasing of an asset. What is the value? They have already given the value. What was the agreed price? This was the agreed price. But when you are raising the finance, what is your total finance? See from all the possible ways. Include all the possible types of finances. It's given already to you from here. 250 share capital, 700 loan, overdraft 700, preference 1200. Add together and you will see this is the finance, total finance you have. 2850, isn't it? You see here? So you are able to raise this much of finance, 2850. Out of which 250 came from equity, 1200 from preference share, 700 from loan, 700 from overdraft. Show the breakdown of this. Okay. You understanding? So out of 2500, 2850 you have been collected. You have collected more. So of the funds raised, only 350,000 will be available to the business after purchase price has been paid. You see, from 2850, if you are paying 2500, that is the agreed price, you'll be left with 350 only. This will be in the form of unused overdraft facility. Okay. Coming to the gearing. Wait. You have to appraise the financing scheme. That means appraise means you have to talk about good and the bad side of this. So you have to talk about gearing. Gearing measures your financial risk. Gearing is a must whenever financing thing comes. Gearing is the easiest one to talk about. Remember this always. Okay. Then the next is the cash commitments. How much cash do you require for each? Okay. If you can see, this was a loan financing structure, right? Loan, then preference share. Show the breakdown. Overdraft. And then you are giving an overall summary. Summary has to be there. It's a report. Okay. If you have some other cash requirements, that also you can talk about. You can even talk about institutional involvement, the shares. Okay, this is the overall report I'm showing you. First, let's go to the subheading before we dive deep into the report. Then the profit growth. It's very important that you talk about profit growth and then the conclusion, because it's a report final conclusion you have to give. Regarding part B will come later, but first let's finish part A. Okay. See, gearing. Measure gearing. How? What is the formula for gearing? Debt over equity. If you see your equity, what is your equity? 250 from 2850, right? So your equity is only 250 out of 250 of debt finance. Why 250 of debt finance? See, this includes the preference share and exclude the unused element of the overdraft. Okay. What is the unused element of the overdraft? Tell me. What is the unused element of the overdraft? See, we have already told that out of this 350 will be available to business after the purchase price. This will be in the form of unused overdraft facility. So that unused overdraft facility is excluded here. Okay. If you wanted to calculate it in terms of percentage, you can do that. So the gearing level will mean that the returns to the equity will be risky, but the buyout team owns 40% of a 2.5 million company, because the value that has been agreed is 2.5 million, isn't it? Out of that, 40% is owned by the team, 60% is by the shareholders. If you calculate 40% of 2.5 million, how much? 100,000. Investment of only 100,000. So now basically you have to talk about the consequences of having gearing, high level of gearing. One consequence is it's difficult to raise additional finance. Okay, and there are unlikely to be any assets that are not secured. All assets are secured in this case. And in the case of level of interest and loan repayments would probably prohibit further borrowing. Remember, if you have to go for a further loan or interest, you'll be prohibited. You cannot go for further borrowing. Now the next is cash commitment. What is your loan repayment? See, your loan was for 700,000, right? Divide this for this. Why? Because it's for 5 years and it is at 12%. Find the cumulative factor from the table. You should be able to find the cumulative discount factor. The table is there. It will be given to you. Please go and check and see, are you getting 3.605 or not? You should be able to get it. Divide it because you want to know what is your installments. And the installments are equal in all the 5 years. You want to find it out, right? Then for preference share, what will be your cash commitment? See, it could be cumulative or non-cumulative. For preference share, we'll see whether it's cumulative or not. Here, nothing has been mentioned, so let's assume it's cumulative. Okay. Assuming that they are cumulative. See, whenever you're assuming something, you have to state it. Assumption needs to be stated in AFM. You can start by saying they might be either this or this, but you are assuming they are cumulative. Let's assume. And with that assumption, go forward and answer your questions. Don't worry. You will get full marks. You might even say it's non-cumulative also an answer. Don't worry. You will still get the marks. But I guess saying cumulative is easier maybe, right? That's why. That could be the reason. We don't know the reason why they have mentioned cumulative. But anyway, it's just an assumption. Assuming that they are cumulative, 120,000 will be on average, has to be paid every year. Why? Why 120,000? See, it is 10% and this is 1,200. 10% on that 1,200 and for 10 years. Understanding? That's why they are paying 120,000 every year. And remember, there is little flexibility. You cannot do anything. Right? You can postpone the dividend, but you cannot avoid this dividend. So flexibility is very little in this. Okay, even after 10 years, you have to repay this redeemable preference share. The dividend needs to be paid. They can either be provided for over the 10 years or an alternative source of finance found to replace the fund. Okay. So let's go by this package and say commitment of this per year, 120,000 per year. And if you go by the loan, it is 194. This is even more than the redeemable preference share per year. Now going by overdraft. Okay. Here, the rate of interest is not known. But let's say we make an unrealistic assumption. As I told you, always state assumption. Whatever it could be unrealistic also, state it. Okay, if we make unrealistic assumption that it is also at 12%, let's say, then how much? 12% of what? Of 700,000 is how much? 12% of 350,000, because only 350,000 overdraft you're using out of the 700. Okay. So this 350 drawn will cost this one. 12% of 350,000 is 42,000 per year. This is less compared to the other two. Right? Just give me one minute. Okay. Now, overall summary. So in total, if you calculate, you have to pay this much, 476 per year. How? Add from all the three. 194,175 from the loan, interest 120 from preference, and 42,000 from overdraft. Add all and see how much. this much. This will be the first point of the new company. The management team will need to generate sufficient funds from the wholly available source operations in order to meet this commitment. Wait. There is an issue here. It is not coming to 476,000. We have to see how 476,000 they have got. So how did we get 476,000? Let's work it out. Okay, so this is how you get 476,000. Okay, the interest of loan. Okay, what is the interest of loan? The loan was 700,000 into 12%, which will give you 84,000. Interest on overdraft. Already it is taken as 42,000. You have calculated it. It's here. And then the overdraft of 350,000. So if you add this 3, okay, because this is a must, it's an obligation you have to pay annually. The others you can delay. For example, the others we are not adding because redeemable preference share, this dividends and all you can delay. Okay, so that's the reason. But interest and all needs to be paid. Okay, you have to pay this. That's why when you add up, you will get 476,000. Okay, that's how you get this. You have a commitment to pay this per year. Now, other cash requirements. All this while you required cash to finance the scheme, but you forgot that you also need cash to invest in working capital and fixed assets. Right? And at the moment, this has been given in the case study, okay, that there will be a 10% annual growth in revenue. If this happens, okay, you need more finance. This might even exit the unused element of overdraft facility also. The 350,000 that is unused, it will extend that also. Understanding? So now we have to talk about institutional involvement because they are also involved in financing this management buyout. Not just management is only giving 40%. They can only finance up to 40%. 60% comes from the other finance. Okay. So if they have a stake in the company at 60% means they have a controlling stake more than 50%. Okay. What is their objective here? See, they only have two objectives. One, to secure the loan and the interest payment. Okay. The other one is they want or they expect to realize their investment in a short time frame, normally between 5 to 7 years. Okay. Because you're appraising the financing this thing. What are you doing here? What is the requirement again? Let's go back to the requirement in case you forgot. You have to appraise the financing scheme. Financing scheme means how it has been financed. 40% by the management, 60% by the institution. You have to talk about the good and the bad. That's why we talked about the institutional involvement here. Now let's talk about the profit growth, because it's not only about generation of cash. The company also must generate steady profit growth. Okay, and the institutional investors will require a history of profit growth. Remember, if they have to invest in your company, okay, if they have to finance the management buyout, they want to see whether you have a history of profit growth or not. Okay, in order to enable them to sell off their stake through either flotation or trade sale. Now what is the conclusion of this financing scheme? See, if you go by this financing scheme, because most of it is from the outside, okay, financial institution, they are going to place heavy cash burden, especially in the early years, on the company. Okay, so if you involve the institution here, it does not look so good. I mean, it's a burdensome for the company. But remember, MBO will be impossible without accepting it, because equity is only less that you have 250, whereas majority of it is portion from the debt only, which is from the institution or the institution. Now coming to part B, where you have to talk about problems in the service compared to manufacturing. This is something which you should know about servicing and manufacturing. This is nothing to do with the case study given to you. One problem I already told, lack of tangible assets. The other problem is service is a people business. The third problem is, there are three problems that have been encountered, is working capital. One by one we'll explain. Regarding assets, okay, see, because MBOs, they require debt, loans and all. These loans and all are secured on some assets. But for service, if you do not have an asset, how are you going to secure? On what are you going to secure the loans that you are taking? You don't have an asset. So in this case, it's difficult to attract debt finance for the service industry. Coming to the second one, which is a people business. Remember, success of the service companies depend on their staff. Okay. So in this case, the success is seen with more suspicion. Why? Because remember, people can resign anytime, but machinery and plant, they cannot resign. So unless the people in the question are tied into the company within this one, okay, they, for example, insisting on their investing in equity, there's a little guarantee that they will stay with the company. Even if you insist them to invest in equity, there'll be very little guarantee they will stay in the company. So it's a problem. But you can invest in the plant and machinery, they will stay there forever. Working capital, the third problem. For the service business, they have unusually high working capital requirement. Why? And the most expensive is the staff cost. Staff cost. Understanding? So the supplies of the service companies often involve a long period of work before customers can be billed. So in this case, a financing package would have to provide for a working capital, and working capital finance is particularly risky because it is difficult to secure and so may be equally difficult to raise also. If you have to secure it on the long period of work, it's very difficult. Unless on assets you can secure. So that's it. Now let's summarize this lecture. So we started with unbundling forms. We told that there are three ways: spin-off or demerger, where the shareholder remains the same, but the companies becomes from one, it becomes two, three, more than two or more, but the shareholders will be the same. Second, sell-off. They are selling a part of a business to a third party, and the shareholders do not remain the same. Third, management buyout, where your existing managers buy the company from you. Management buyout versus management buy-in. Buy-in means external managers will buy it from you. We went through all the reasons for management buyout. Then issues that needs to be addressed when preparing a buyout proposal. The questions I told you, whether shareholders are willing to sell it. Okay. Do the management buyout have the expertise? Do they have the finance? Can they convert the loss making into profit making? All those things. Sources of finance. They can go to venture capitalists, banks, government agency. Assessing the viability, how viable the buyout is. Okay. Do you have the projections? Do you have the cash flow forecast? Do you have the expertise? Do you have the finance? Do you have the right source of finance? Evaluating the benefit of reorganization. 3 benefits. Remember the 3 benefits. It reduces complexity and helps you to improve your manager efficiency. Then corporate growth and maximize shareholders' wealth. And the last one. What is the last one? It gives you time to concentrate on your core business activity. Okay, it helps you to release cash, release fund, and invest in elsewhere. So thank you for watching this lecture, and please practice questions on reconstruction and reorganization. There are lots of questions, and mostly you will see it as a 50 marks question. So make sure that you master this area in order to pass AFM with very high marks. Because I know people, they are good in AFM, they know all the other areas, but they lack a little bit of practice in this area. And if you put that little bit extra practice in this area, I can guarantee you your marks will be around 70 to 80% in AFM. So see you in the last section of AFM. This is the easiest section. Mostly it's theory. For your discussion question, it will help you. We have little bit of calculation also, like dividend capacity and all those things. But mostly it's theory. So the next lecture onwards till the last lecture will be on your section A of the syllabus. That is the role of the financial advisor. We are going to talk about all MNCs, how financial advisor deals with MNCs issues, then ethics, right? At least one ethical question you'll be having it. You will be having a question from section A of your AFM syllabus, don't worry. Okay, so I'll be including that as well. So see you in the next lecture, and thank you for watching. Best of luck for your AFM exam.